If you're paid weekly, sometimes you're going to get 5 checks. If you're paid biweekly, sometimes you're going to get 3. You're never going to have the same exact amount of money every single month for the year. You're also never going to spend the same amount of money every month for the year because the price of the basic things that you do fluctuates. And sometimes you do more things and sometimes you do less things. And sometimes you have emergency spending and sometimes it costs more to take the dog to the vet or whatever you're doing. You're never going to spend the same amount of money every single month. So you want to look at this on a trailing basis and try to identify trends, exactly like we do for businesses. And then finally, the cash flow statement, very similar to budgeting, very much the same thing with businesses. It's going to detail where your cash or your monthly inflows or your income is coming from. And again, it's going to help us to manage liquidity to make sure that you can continue to operate and honor your obligations. And if there are liquidity issues or bottlenecks, then we're going to go back into the other 2 statements and look at where that liquidity is falling short and what we might need to switch up or restructure with debt or cut on spending or whatever to free up more liquidity. Because again, free cash flow is where it's at, right? Free cash flow, it's blood in your body. It allows you to continue moving. Incredibly important. Okay. The last thing of the 5 that I work on with folks is understanding the role of working capital. Now, I've alluded to this a couple times throughout the other points, but working capital is just basically the difference between your current assets and your current liabilities. In business, we're going to call this the quick ratio. And we want to understand how efficient your operations are, and we want to make sure that you have more assets or more cash available to pay the current or the when we say current liabilities, we're thinking about things that are due within less than 1 year. And so we're not talking about long-term debts. We're not talking about mortgages. We're not talking generally about credit cards, things like that. Although sometimes credit cards would be considered a current liability. And so we want to make sure that we understand what that means for your business. And so we're going to look at that. It's short-term stuff.